Everyone's worrying about a recession, but the data tells a different story. Let me show you what the market is really saying. We constantly see news articles about this big crash coming or a recession that's just around the corner, and I never knew if I should take my money out to avoid this recession or if I should put more money in because the economy is just starting to grow. So I made it a mission to figure this out. I asked myself the question, how do the big fund managers and how do the hedge funds know the real health of the economy so that they can actually make good decisions? I went deep down this rabbit hole and I figured out what is the 80-20 of figuring out if the economy is actually healthy or if we are, in fact, heading for a recession. So let's jump into my computer, and on the right here you can see Fred, which is the Federal Reserve Economic Data website. So this is just a public dashboard that effectively tells us what the Federal Reserve is doing at any given moment. So when I was going deep down my little rabbit hole, I basically figured out that these 6 graphs, when interpreted together, can give a very accurate kind of idea of what the economy looks like at a given time. So it can get extremely complicated. There are just hundreds of these graphs that you can look at. But I asked myself, what's the 80-20? What are the fewest possible graphs that can give us the most accurate picture? So I'm not going to pretend like I can interpret them like some economics wizard. But basically what I did is I took a screenshot of this and I put it in ChatGPT. And I said, can you explain in simple terms what each of these graphs mean? So let's go through each of them and get an actual idea of what the market looks like right now. So we can see the first one here is a high yield credit spread. So if you've got a company that's a little bit risky and more likely to default on a payment, so you lend the company money and it's more likely to default, then this graph shows you how much extra interest is being added onto those loans. So you've got investors like banks and all of these things that give out loans, and they have entire teams of people that are analyzing the economy. And this graph is telling us, okay, well, how much extra interest are they adding onto this? Because if they add more interest, it means they're nervous. It means they want to get better compensation for the heightened risk of default, effectively what it's saying. So you can see if it's trending down, it means that investors are confident. So you can see over here, they're pretty confident. And these kind of gray areas or shaded areas are all recessions. So you can see there's big spikes. The investors require higher interest rates during recessions. So this is what this graph is telling us. The next one is the total assets. So the Federal Reserve is effectively investing in the economy at a given time, right? They're pumping money into the system. And you can see over here, 2020 was COVID, so they basically prevented a recession by pumping money into the economy. You can see over here, it's at a sky high rate, and then it's falling, right? The Fed is basically taking out money from the economy. They're reducing it. It's at an elevated state right now. Okay, so if it's rising fast, it means the Fed's stimulating economy. So you see over here in recessions, the Fed is pumping money in to stimulate the economy and take us out of recessions, is effectively my understanding of it. So if it's falling, the Fed is tightening liquidity. So you see over here, a falling sign is generally quite a good sign, okay? Now we go into the federal funds rate. This is the interest rate. This is what we see on the news all the time. And you can see recently there's been a lot of news about how the interest rate's dropping. And this is showing that, okay? So rising rates mean that the Fed is fighting inflation. So they're trying to reduce inflation with higher interest rates. And falling rates means the Fed is stimulating growth. They're making it easier to get money, it's cheaper to get money, and it's stimulating growth. So now this is affecting mortgages, loans, market valuations. So you often see the stocks climbing whenever the interest rate drops. And this is kind of what we've seen over here. Now we've got over on this graph, the 10-year minus 2-year treasury spread. It's a mouthful, but basically what it is it's the difference between long-term and short-term government bond yields. So if it's climbing, it's a positive sign. It means it's a healthy economy. And if it's negative or inverted, you see this black line, if it's inverted, it's a recession risk. So if it's dropping, recession risk is rising. Every single time it goes under this line, it's basically triggered a recession at a later point. So you can see it under here, recession, under here, recession, and so on. So you can see over here, we actually had one over here. This is basically one of the most watched recession warning signals. So if you see this is how a lot of news publications can justify saying a recession's around the corner effectively. But you can't get an accurate picture from just one graph. This is what I'm kind of trying to get across to you. Now we've got number 5. This is the unemployment rate over here. So, I mean, it speaks for itself. How many people can get a job that actually want a job? So you see over here, the big spikes in recessions again, in the gray areas, and a big spike in COVID. So you can see it's actually historically low. When the news is saying that people are losing their jobs to AI and all of that, maybe it's slightly true, but what they aren't saying is that it's at historically low rates, the unemployment rate. And now the final one is the consumer price index. And this is basically a measure of inflation. If it's climbing sharply and highly, it means that there's a lot of inflation. And then if it's flat or falling, it means inflation is reducing or cooling. So long-term steady climb is normal inflation. A steeper recent slope shows post-2020 inflation surge. So this steepness is post-2020, the COVID kind of inflation surge. But you can see this is actually a generally healthy inflation, but it's high, is kind of how we're seeing this. So now, like I said, you have to kind of take them together. So what's the big picture? I said, what's the overall picture of the market? And now the honest short-term picture is that it's stable but late cycle. So what this means is we go through economic cycles. I think it's every 5 to 10 years or 8 to 10 years, you go into a recession. And that's just normal economic cycles. So what it's effectively saying is we're stable right now. There's low recession risk right now, but over the next few years, there could be one. It's late cycle. That's what it's saying. And this is what looks healthy. The credit spreads are low. So what this is saying is investors aren't worried. Like I said, they have teams looking at this and they aren't worried. So unemployment's still low. This, you can see it always spikes during recession. So it's low, right? It's climbing, but it's low. Then we've got neutral but late cycle. So this is where the justification of, we're later. The Fed funds rate is elevated. So that's this, right? It's slightly elevated, but this is kind of post-COVID 2020. It is dropping to stimulate growth. Then you got the Fed balance sheet is shrinking. That's over here. You can see that they're pulling out funds. Also, you could argue that because it's so elevated from COVID, maybe this is normal behavior. So that's kind of how I view it. But this means there's less artificial support. And this is a very big signal of volatility in the market. So you can see because companies have access to less assets, they are slightly more volatile. Investors are a little bit more concerned, and that's showing just the volatility. And now there's only really 2 big warning signals. And the first one we spoke about earlier is this inversion. So you can see in the graph, every time there's been an inversion, it precedes a recession. So we can see over here, but we haven't had a recession. But who's to say it doesn't come in the next year or 2? So this is a warning signal. And then we've got the inflation backdrop. And obviously inflation is really high. The Fed cannot cut aggressively yet. So we can't effectively drop inflation right now. And so they're likely to stay higher for longer. And this is just it's just a factor. So the final thing I did is I said, what's your estimated recession risk for this year, 3 years, and 5 years? So here it is. Next 12 months, 30 to 40%. Next 3 years, 55 to 65%. And the next 5 years is 75 to 85%. And this is just a reality of economic cycles. So if you look in the information box below, the bio below, I'm going to add basically a link to this. At any time you can come in, just screenshot it and have a conversation with ChatGPT. It can help you with your decisions. It's been really, really helpful for me. I hope it helps you. Make sure you grab it, keep a little bookmark of it, and then at any time you're feeling nervous, you want to make a better decision, just take it and have a conversation with ChatGPT. I hope this helped. If you like it, please like and subscribe. It really, really helps me. If you want to download my 60-minute investing plan, then you can also find a link in the bio. Comment stocks below and I will send it to you. Thank you so much for watching, and I'll see you in the next one.